Many people are questioning what's happening right now with the economy. They see the signs, they look down the road and try to explain it for themselves, but unfortunately, we're getting mixed signals. In today's video, I'm going to show you what will clarify that for you. It's very important to actually look at very specific subsets of data, and you're not going to get that on the mainstream. And of course, the alternative media generally are ignorant to this information as well. So I'm going to show you what you need to know. Let's begin by taking a look here. The Fed and the stock market are set for a showdown this week. Oh my goodness. It's going to be a big showdown, right? Because the Federal Reserve, according to this article and a couple others I've seen, is that Powell's going to show the market who's boss. He's going to make sure he's real tough. Really? You really believe that? The unstoppable stock market is about to meet an immovable Fed. What happens next? If anybody believes this, I've got a bridge to sell you. I've got oceanfront property in, Arizona to sell you. It's ridiculous. What we have today is the fact that financial conditions, believe it or not, financial conditions are as easy as they were back in 2019 as they are today. Now that's measured by many different metrics, but if you just look up Financial Conditions Index, can you believe it that today it's as easy as it was back then? It's as if all this tightening in some ways doesn't matter. That's the way the market has perceived everything so far. It's that we don't have to worry. As long as we can just hold on real tight, we're gonna be okay in due time. What time? We'll see. The Federal Reserve is suggesting, no, you're not getting any cuts this year. However, the market is saying, yeah, we're going to get cuts this year. In fact, in Canada, the market is already pricing in cuts in the second half of 2023. So they're coming earlier. Other central banks might be doing that same thing. So the US is basically going to have to go against the grain. Really? Is that what they're going to do? I mean, it's possible, but I'm not so sure. Well, look. There's several things here that I will break down in this video. This is one just talking about the different leaders of the big tech companies. Yeah, they're laying people off and kind of is explaining what they are saying specifically at the top. Here is some of the world's corporate leaders and what they said about the economy, labor, inflation, all that stuff. So we're talking about Microsoft. A few things are increasingly clear. Just as we saw customers accelerate their digital spend during 2020, we are now seeing them optimize. Don't say cut, don't say eliminate, don't say reduce, just say optimize. Also, organizations are exercising caution given the macroeconomic uncertainty. Of course, worried about recession, worried about what's going to happen. So the companies are saying we're going to lay people off. Okay, I'm just translating this for you. Also, organizations are exercising caution, said that, and the next major wave of computing is being born as we turn into the world's most advanced AI models. And they're saying, hey, we're going towards AI, and by the way, we're not going to need a lot of these jobs coming up. So the next cycle will be different. This is what I've been warning about for a long time. It's that when we move through a cycle, you get to see this. You move through a cycle, okay? There are hard times, there are recessions. This happens all the time. What people think is that when we come back through that cycle, people get hired again, unemployment rate goes down and so on. But in this cycle here, if unemployment does rise, I mean, it depends on if you want to look at their stats, the U3 unemployment rate, or you can look at other stats that actually make more sense. When you look at that data, it's going to come through, and should it decide to rise, it may not go down because we have robotics, because we have automation. I showed something on my Twitter where you had this robot picking like 20 apples in 1 minute. A human cannot compete with that. There's no price. What about Flippy the robot? Flippy works 24/7. You don't need an employee to work 24/7. You don't need 3 8-hour shifts. You need one robot. Sure, if Flippy breaks down, you got yourself a problem. They need to unhook it probably, and then they need to get human being working in there. But how often does it break? I'll tell you, it doesn't break as often as a human with their, every hour they need to go off for the smoke breaks and all these things. At least that's what the companies are saying. The companies are saying this stuff. I'm just bringing it to you. They say it in the conference calls. They say it in the interviews. They talk about it at Davos. I pay attention to that stuff and I disseminate that to you. If you are interested, all you got to do is subscribe. When you subscribe, you get the latest and greatest, and you get it explained in English, translated in human language, okay? Car repossessions are on the rise, in warning sign for the economy. After auto repossessions tumbled in 2020, just like people, they weren't being kicked out of their homes, the rent moratoriums were in, same situation. They are now approaching their pre-2020 levels, with industry analysts worried that the trend will continue. The loans on homes, the loans on cars, all of these things have been much more expensive than most people had been accustomed to, and they're paying much more for it. That's coming up. Did you need to be a genius to figure this out? Yeah, there's going to be more repossessions. There's going to be more bills that are unpaid. People are using their credit cards. Buy now, pay later is skyrocketing. Yep, happening right now. Weaker orders, investment, and underscore the ailing U.S. manufacturing. Manufacturing will not come back to the United States. It would take some serious issues, major wars for that to be the case. Not happening anytime soon. Yes, stuff is manufactured in the US, but for the most part, the stuff gets made in developing nations and imported. Why? Because the prices of these items need to be low in order for people to afford them. That's it, or else they just couldn't have it. So you manufacture that in a different country, bring it in. The shipping, relatively cheap, or at least, other than 2020 and 2021, relatively cheap. It's worth it to do that. That's what these companies are doing. I'm just showing you the economic aspects, not the morality, not what people should and shouldn't be doing. I'm trying to bring you, what's going on. Let's talk about the next issue here today. Okay. It's very important that we watch the markets. Okay. Look, Carvana stock soars in active trading to lead the NYSE's gainers. Carvana. Does anybody know this stock? It plunged by 97%, I believe, from peak to trough. Really hot stock, 2020. Oh, this is going to be the next greatest thing. It's going to be the next Tesla. It's going to be the next Amazon for no reason. Let's get all in on that. Retail traders just bought it up. And then it dropped 97%. And then in one single trading session, it surged by 20%. This is the type of speculative behavior that needs to be washed away. And if it doesn't, you will have reoccurring problems over and over and over again. And every time they'll be worse. This needs to be wiped out. I called it in my first book an economic detox. Yet that's not happening because the Federal Reserve is supposedly going to cut interest rates already this year. Already. And they didn't even bring interest rates up to a respectable level. Can you believe that? Lucid stock soars amid Saudi buyout speculation. I pointed this out on my Twitter. Just wanted to highlight the fact that, do they have funding secured at 420? Well, who knows? We'll see. This is one company that, people are trying to find what's the next Tesla. I missed the Tesla boat. I need to buy the next Tesla. So here it is, Lucid. I heard of something ridiculous, like 60 new EV car companies just in China alone. There's just too many, and we have to figure out a way to wash all of this clean. And how do we do that? Well, it happens naturally. When something needs to go bankrupt, that's okay. A stronger company comes in and buys the assets that are worthwhile, and business continues. That's the way it should work anyway. Bed Bath & Beyond says it can't pay what it owes. This is a stock that was being bought up like crazy. You remember this? Bed Bath & Beyond, let's get on it. Meme stocks, all this nonsense. Was there any reason for that? Of course not. And now they can't pay their bills. People were pouring their life savings, retail traders pouring their life savings, and this company couldn't even pay their bills. This is the greater fool theory, and they know it. Do not get into these type of investments. Stick with the strength. I know there's not going to be 20% gains in a single day. Well, Tesla has seen some ridiculous price action on the way up and the way down. That's besides the point. And then just stay into the things that are strong. That's the point, okay? And for most people, quite frankly, not buying individual stocks is not a good idea for most people. Okay? It just is not. Just isn't. Now, this is a really good article. If you have the time, check it out. Links are in the description. It's talking about the cheap money and how that's come to an end. based on certain metrics. Looking at this article just gets into different things, like what's happening with IPOs. IPOs are at a standstill. Even venture capital. I can tell you in my experience, looking at VCs, venture capital, I've talked to two people on the inside making the purchases, and essentially it's not done. It's not like, okay, the SPAC market that nobody wants anything to do with anymore, at least for now. The VCs are kind of just more hesitant. So that the money's moving a little bit tighter now, a little bit more restrictive. They're still happening. Purchases are still occurring, but the valuations are not as high as they once were before because the debt isn't as cheap. And that's further along here. They do discuss that somewhat. Just looking at this in general, I could show you some other things. The freezing and frozen segments of the economy, venture capital, as they highlight here. They give you lots of quotes. Everybody's favorite, SBF, Sam Bankman-Fried. Freed, as in, he's been freed so far. IPOs. Housing has some serious issues. Look at this mortgage purchase application index down significantly. However, just recently things have turned around because mortgage rates have, flipped. I wouldn't say flipped, but they've come down from their highs quite a bit. I believe it's under 6% at this point, and it was over 7%. So, you can look at the housing market, just look how tight things get. And the point here is that when the money supply and when interest rates are changing, that's going to have an impact on the financial markets. It's going to have an impact on jobs and so on. So it's pretty obvious. And that's just one example. You could see the Fed's preferred inflation gauge far above its goal. That yellow-orange line going across there, that is the Fed's inflation goal of 2%. They are currently on their own statistics looking at 5%. So that 5% here, well off where they need to be, the 2%. How do they do that if they want to actually bring inflation down? They have to leave interest rates at a reasonably high level for longer. However, all they need to say is that we're going to do a range. Okay, we're not going to increase. We're not going to increase our target. We're going to have a range, 2% to 4%, or maybe 2% to 3%, and they will just say and signal this is coming in the next 12 months, and that's it. Market's happy, and that's it. The inflation story's over. Okay. Now, everybody dealing with inflation today, I know you've been seeing the stories about eggs. Vital Farm raised egg prices, quote, reluctantly and in small amounts, according to the CEO. They had to deal with fuel costs. They had to deal with a lot of their other input costs. And this is true. That's the fact. But the point I make right now, and that I always make, is that when prices go up, did they ever come back down to that price we saw before? Like, let's say it was $1 before things went crazy. They went up to $2. Then things are easy now. What about the fuel? Think about fuel surcharges, right? Fuel surcharges on your delivery, fuel surcharges on your plane tickets. Let's say $1 goes to $2. Everything's back to easy now, right? Remember fuel? I should say oil was trading at the negative at one point for a brief period. Remember that? Oil was so low, they had to pay people to get rid of it. That's how low it was. Did the fuel surcharges go off any of these things? Absolutely not. So what happens is that $2, maybe it's $1.75 now, maybe it's $1.50, but it never goes back to the $1. Even if all other things considered had reduced back down to where they were before. That's the way it goes. I hope people see that. I hope people recognize this pattern. Look at this. Welcome to 2023 living wage surcharge of 3%. 3%. So the company is saying we can't pay this person that extra dollar. And I guess it's kind of like a forced tipping. Like, is that what this is? But we're seeing all kinds. I mean, I did see during 2020, they were just adding a lot of things to the bill. And this is part of inflation. It doesn't get recognized as inflation, just like shrinkflation doesn't get recognized as inflation. Other things too. Okay? So these are the I don't want to call them calculations, but these are the ways that we have to determine how expensive things have really become, because they're not going to do that. We know that. We know this. And this is basically just an article that I've shown you many times, that highlights the fact that people are using their credit cards more than ever before. They don't have the ability to pay for a $1,000 emergency. They have to use their credit cards. It's a large percentage of the public. Paycheck to paycheck, you know the story. Okay? So basically, that's what I wanted to show you today. I'm highlighting the truths that are out here. I'm breaking it down, making it simple and easy to understand. If you appreciate that, simply hit the subscribe. Why? Because at this channel, you get the ins and outs of what's happening literally at the most complex stages of the Federal Reserve, of the monetary system. And I try to sneak that into you to make sure you are aware of this. Layman's terms, I'm always trying to bring you the easiest, the latest and greatest. It's right here. Hit that subscribe and I'll see you tomorrow. Take care.